Okay, everybody. Thanks for selecting us for the first breakout session of the afternoon. The title of our session is Capital Markets Trends. And up here we have four folks that I'll introduce in just a moment. But I wanted to kind of get everybody into the conversation a little bit. We've spent a couple of hours hearing from some really knowledgeable folks about the marketplace. We've seen all sorts of great graphs. But let me take the temperature out there for the benefit of our panelists up here. As we are now deep into 2016, and there's all sorts of things going on, from great construction activity to capital flowing in, to low interest rates continuing, to a political environment that nobody would have ever guessed we'd be in. I'd like to ask you, by show of hands, how many people feel good about the prospects for doing business for the balance of this year? How many people feel good? How many people feel okay? Okay, a couple of okays. How many people think we're about to fall off the cliff? Okay, we've got a couple of people. But by and large, most of us in our little breakout session now feel pretty good that things are good. Okay, let me ask another question. How many of you, in what you do every day, are impacted by the flow of capital? Everybody, okay? So you don't have to be a lender. You could be an investor. You could be anything from a trade. You could be a contractor, an architect. You could be in the transaction sales or leasing end of it. Capital is the lifeblood of commercial real estate. Right now, we've got four experts up here, all that come from different disciplines of the capital markets. First, I'd like to introduce, on my far left, your right, is Pat Ramge. Pat is with Wells Fargo. He's a senior vice president. He's based in Fort Lauderdale, but he has, as regional manager, he has a responsibility for the whole state of Florida for the commercial real estate activity that Wells Fargo does. Pat joined Wells Fargo in 2003 to open up the Fort Lauderdale office, and he has 25 years of experience in the financial services arena, with not only with Wells Fargo, but the old Chase Manhattan Bank and Comerica. So Pat today really represents someone who has been involved in very large, very complex transactions, primarily on the debt side and the CMBS side, debt in terms of traditional bank debt, as well as CMBS originations. Next, I want to introduce, I'm going to bounce around a little bit. We're going to introduce Chuck Davis, who's right next to him. Chuck was a former banker, a reform banker, had been with B of A back in the day, but he has been with MetLife, and he heads their Southeast Regional Office in Atlanta. For many, many years, he was based in Tampa, but he joined MetLife in 1995. He is responsible for $8.6 billion of debt and equity. So, you know, he represents really two different sides of the capital flow, debt investment as well as equity from a life company perspective. Prior to that, he was involved with asset management. He's been involved in many, many professional and trade associations, and he has been involved with the Bergstrom Council and the advisory board for many, many years. On this side, we have Steve DeRose. Steve is with Starwood, and in his role with Starwood, he's responsible for the origination, the structuring, and the closing of loans for all different property types. He's really representing more of the CMBS and non-bank type lending activity. Prior to that, he was with a boutique investment firm, Tannery Brook Partners, and he also has Wells Fargo lineage in his background, where he was involved in their special servicing. So he's not only originated loans, he's worked them out as well and restructured them. And then last up, we have Rick Scarola. Rick, over the past 20 years, has been very, very active in basically investment strategy, acquisition, business development, and asset disposition. Most of his activity centers on the multifamily market. The multifamily market is one that's very, very active right now. The flow of capital from the debt and investment side has been very, very strong. And Rick today will share with us some of his insights as to what he sees from his vantage point, really more as a consumer of debt and equity. So with that, what we're going to do is we're going to start out, and we're first going to talk about the current capital environment. And what I'd like to do is, the first question that I have is, I'll start with, we'll go ahead and start with Pat on the end. Given the very competitive environment right now, how has Wells Fargo kind of adapted their lending criteria to what's a really competitive environment to win good business?
Okay. No pressure. Yeah, good. All right, so I would say that we've been relatively flat on how we looked at deals over the past 13 years that I've actually been there. Okay, so we've been relatively consistent over the past 13 years that I've been at the bank, and we underwrite primarily to a cash flow versus a loan to cost or a loan to value perspective. I would say that where we've tried to be competitive, and we sort of have policy as well as guidelines, and we try to stay within the guidelines and try to stay away from the policies, so we don't have many exceptions because the regulators don't like them. But I would say where we've moved the most in the competitive environment in the past couple of years is that some of the deals that we've done, we've actually have stretched on our debt yields that we're requiring in order to win a deal, given the merits of the transaction that we're looking at.
And Pat, for the audience benefit, what's your sweet spot? Tell us a little bit about what your team within Florida looks for in terms of size of deal, type of deal. I was kind of put on the spot by Jim Freed about construction lending, but what is it that you're really looking for in today's current environment?
All right, so Wells Fargo has six within my group, which is commercial real estate. There are 6 separate lines of businesses, and I'm actually in the generalist group. We have, just real fast, single-family residential, we have a senior housing group, we have a REIT group, we have a hospitality group, and we have a merchant banking group, and then me. And I do sort of the basic food groups of multifamily, office, retail, industrial, condo, and to a lesser extent the condos. But that's what we do, and I would say over the past 3 or 4 years, 70% of our business has been more on the construction side, which was a little bit of a switch from where we've been prior to that 3 or 4 years, where we were doing a lot of standing loans, given where the markets were.
How about in terms of deal size? Is there a minimum that your team, the generalist group, looks at, and is there a maximum, and is there kind of a sweet spot?
There's no maximum. It's all a function of how much we're willing to hold of it. If we did a deal last year which was $340 million, and we held 135 of that, and we syndicated the balance of it. I would say it's all based on the relationship. I think what we try to do is develop a relationship. We're not transactions, so develop a relationship where we can put out a lot of money. I think our sweet spot's probably in between sort of the 25 to 75. But we'll do smaller deals too, where we've done, for the sake of relationship, we've done $3 million deals. But in the broader scheme of things, it's a larger relationship.
And I think by contrast, the bank that I work for, it's a $5 billion bank, Sabadell United Bank. Our sweet spot is probably 5 to 25, so you can see kind of the segmentation. And Pat knows that every once in a while we'll go up above the 25, but it's usually driven by a terrific client opportunity, because when you get to the 25, 50, 75 millions, you're going to get the folks like Kim Abreu at Bank of America, or you're going to get the Pat Ramges, who are going to be just, that's more of their sweet spot than a bank like mine that's more of a super community bank. Let me go ahead and switch it over to Chuck Davis. Chuck, with MetLife, you have a very, very big portfolio. Your area of responsibility is bigger than my whole bank. At $5 billion. But tell us about your sweet spot. What is it that within your responsibility at MetLife, what are you looking for?
Okay, general summary. How many people are here for the NBA? A few people here for the NBA. So if I say anything wrong against whatever my brethren said, don't hold it against me. But it hasn't really changed that much. Probably Since I've been with MetLife now a little over 21 years, originally a small loan to us was somewhere around 10 million. Now a small loan's like 20. Not too different than Wells Fargo, although occasionally in the Southeast we'll go below that. So kind of our sweet spot is doing 50 to 65% leverage. We do a lot of acquisition financing. We do a lot of portfolios on a national basis. I think the largest loan, actually in my career, we actually lent money on the 3 hotels at Universal last year for $500 million, and all that's on our books. So we have a tendency to fund a lot of these deals and keep them. More recently, you might have heard that MetLife actually has a debt fund now, which will do things that are probably a little bit outside of our sweet spot, maybe different markets, maybe a little more leverage than what we're used to, maybe that goes to 70, 75%, and priced a little bit higher. And then we actually we have 6 different financial institutions that we actually invest on behalf of. They usually buy participation certificates into some of our projects. Some are life companies, some are banks, actually. So last year in my region, we did $2 billion, with 4 producers. So you do a lot of loans, 25 loans, try to make that happen. But around the United States, we did around 12 to 13. Then you throw in international, it was around $14 billion last year. And our goal this year is $15 billion. So I don't see that slowing down. It's very active right now.
For your group, Chuck, do you go offshore? Are you involved with debt or equity investments offshore?
Like Puerto Rico, you mean?
Puerto Rico or beyond?
Yeah, the farthest my group's gone is actually Jamaica, Bahamas, and Puerto Rico. But we do have a major office in Mexico City. We're one of the largest lenders in Mexico. We actually have a large office in Santiago. We have an office in Tokyo and a pretty good office in London that basically covers Europe.
And how much of MetLife's business that you're involved with is financing existing product versus development? Yeah,
so that's probably a real change from my banking days. So very rarely do we do construction loans. Some of you know I've tried to push MetLife to do construction permit loans. We've done that a few times. Here in Orlando, we did the 2 CNL towers with what was then First Union. And so we have 1 construction permit loan we're doing right now on a hotel going up in Charleston, but that's not our bailiwick. Our bailiwick's really doing acquisition financing, refinances, and we actually are doing more mezzanine equity and mezzanine debt now. So, playing the capital stack in different spots is probably the best way to put it, but really more of a permanent lender, although I do have to add, we were probably one of the largest floating rate lenders of all the life companies. Probably 55% of what we did last year, I think, was floating rate. It'll probably stay somewhat like that or a little bit less. I think people are a little heebie-jeebie about whether or not the fixed market's had its run and whether or not treasuries will go up, and lo and behold, they went down. So still a good time to be a borrower floating and fixed right now.
Okay, great. Steve DeRose, Starwood, not a bank, not a life insurance company, but yet is involved in a lot of financing. Tell us about kind of what your sweet spot is and the type of business that you're involved with.
Sure, and to clarify, there's Starwood is a fairly household name, but there are lots of different pieces of the organization. My group is the fixed rate conduit origination group, so we do fixed rate CMBS loans that we originate with our balance sheet, and then we'll securitize in the market. Our other parts of the family that we are all integrated with there's Starwood Capital Group, which is our private equity side of the business. Starwood Property Trust is we're the largest publicly traded commercial mortgage REIT, and that's the part of the business where my group fits in. And we're married at the hip with a subsidiary company that we bought about 3 years ago called LNR, and LNR is based out of Miami Beach and is the largest of the CMBS special servicers in the world, with I think we've got about $112 billion of loan exposure in CMBS, of which I think right now like $12 billion of that is sitting in our shop in special servicing, either through it's there for everything from loan workouts to we foreclosed on the asset and took it back, and it's sitting in our REO portfolio. But my role is working on the new loan origination side, working in CMBS loans, and last year our group was the most active CMBS shop on Wall Street. We did 18 securitizations last year. You compare that against, for example, Goldman, I think, did 8. So we move, we close loans quickly, and then we have a quick velocity of how long they, as I like to say, graze our balance sheet, and then make it off into the securitized world. So, which has been pretty important, particularly the last 45 days.
So of the 18 securitizations that your firm was involved with last year, can you venture a guess how many individual loans were inside those 18 securitizations?
You know, I don't know the exact number of loans. I'll tell you that we'll do loans $5 million and up, and it's on all of the main food groups all over the country. We'll do anything from primary markets to secondary to tertiary markets, and again, it's across the U.S. So there's not a particular market or product type that we do or do not focus on. We'll cover all of them. Our average loan size, we did 18 securitizations, which was about $2.2 billion, and that I think was an average loan amount of $15 million. So while we do some large loans, we do a lot of the $10 to $20 million loans as well in order to make up that.
Okay. Rick, in your role with Covenant, and I know you've been involved with other funds and other firms as well, what's your sweet spot in terms of size of deal, type of deal, and then maybe a little more specifically, where do you source your debt and equity capital from?
Well, I'm listening to the group here, and I've probably done, borrowed $2 billion in the last 15 years, and none of these three are my lenders. So I don't know what that says for us, but I don't think we don't play in their arena. Our business is the value-add apartment business, so we do stabilized loans at the end of a completion of a project, as well as construction rehab. Prior to 2007, I would say 95% of our debt came from Fannie and Freddie. They had programs set up for rehab. Post 2007, our majority of our loans come from on the rehab side. I would say probably either a bank, a regional size bank, or smaller like your size bank, does a non-recourse loan for us at 70 to 75%, because our funds are, $250, $300 million, so they have some protection from us. And on the stabilized, it still is Fannie and Freddie. We don't do much life insurance work because we don't get enough leverage usually from the world that these people play in, and our loan sizes are probably $15 to $20 million on average. The problem we have with them as a lender for us is the assumption. It's very difficult to assume a conduit loan because they've securitized it. I don't know, are you guys doing the servicing?
Not on all of our loans.
Yeah, so they give out the servicing, and that's miserable because to get a conduit loan assumed, we found takes between 6 and 8 months, just because there's a special servicer and somebody else. Life insurance companies are a little easier, but life insurance companies don't play in our arena much. And then the banks are out there, but usually a bank of Wells Fargo size is too big to pay attention to us because we're not borrowing enough money to play. Now, we do regions, but they're also one of our biggest lenders.
So when you mention leverage of 70 to 75%, is that of the acquisition cost?
Just acquisitions.
And that's on the value adds?
No, we do the value add out of our own capital.
Okay, so you use your own capital, use bank capital to get in on an as-is basis, you enhance the property, and then traditionally
Fannie and
flip
Freddie.
it,
Yeah,
Fannie
well, we
and
probably
Freddie
refinance most of the time within a year to 18 months. We've raised the rents, whatever we've done, and then we'll go to Fannie or Freddie as a takeout.
Okay. Question for you, Steve, and it's kind of a takeoff on the first question that I asked Pat, is if you think about the go-go days of CMBS 1.0 or whatever version that was that that kind of came to a halt. What's being done differently now in the current environment? Can you speak to that? And what safeguards are there to make sure that there's not another LNR opportunity where they have, what was it, $118 billion of special servicing?
Well, there's a big difference between what I'll call, the industry knows as CMBS 1.0, which was pre-2008 financial crisis, and then there's CMBS 2.0, which is post-crisis where we are today, and we're soon to embark on what I'll call CMBS 3.0, or some people, there's a differentiation between 3 and what is about to become 4.0, which is a fairly big change that will start to take place in the fourth quarter of this year due to regulatory changes. So difference between pre-financial crisis 1.0 versus 2.0 where we are today, it's a very significant difference. You've got, if you look at the deals that were sold and securitized prior to the financial crisis, first of all, usually those deals were anywhere from 2 to, in some cases, you saw them as much as $3 billion, and the number of loans that were in those pools were fairly significant. And so there were a lot more loans in those pools. They were higher leverage, particularly as you got into late 05, 06, and early 07. You would see leverage points go up to 80%, and sometimes that wasn't even on acquisition financing. That was on a refinance where there may not be true cash equity in the deal, and there was a bigger, what I'll call, shadow universe of bond buyers that were out there that weren't doing as much of the due diligence on the underlying collateral in those, meaning special purpose vehicles or SIVs that were buying in large part, big pieces of paper in the AAA bonds, et cetera. That doesn't exist today. Today, the deals are a lot smaller in size. The average size is about $1 billion, and comprises anywhere from 70 to 100 loans, and there's a smaller universe of B-piece buyers that are kicking the tires and doing the homework. Same all the way through the capital stack. If you look at buyers even at the AAA level, it's the same. There's a much smaller universe of buyers of that paper. So there's more discipline on the market today than there was in CMBS 1.0.
So what would you say if maximum leverage got up to 80% or got up to levels where there wasn't true cash in the deals that 1.0 did? What's the maximum leverage that you're seeing being done now?
Well, maximum leverage in CMBS today is 75%. And the other big difference, what I'll call implied leverage, is through interest only. So that was the other big differentiating factor behind where CMBS 1.0 is versus today. CMBS 1.0, there was wasn't unusual to see 5 or 10 years of IO, even with full cash out, and we're about to see how that plays out in for those loans that were done 10 years ago. That haven't had the benefit of amortization, that were financed at the peak of the prior market. The fecal matter is heading towards the oscillating electrical appliance in some cases. So it'll be interesting to see how it plays out. In today's world, you see implied leverage. IO is much less significant. Albeit it has crept up over the last 24 months, but it's nowhere near, to get full-term IO, you really need to be in the 50 to 60% leverage with good metrics and historical coverage, whereas prior to the financial crisis, it was handed out like candy.
50 to 60% based on cost or based on current appraised value?
Well, yeah. So on appraised value, but then on a refi, it comes into also play. What a borrower's cost basis is in the deal as well. So.
Okay, and there's definitely benefits in Chuck's world when you're dealing with a life company. You're dealing with a portfolio lender. You have more of a relationship than you do if you go the CMBS route. Chuck, from your standpoint, if CMBS will do maximum 75%. Where do you and your competitors in the life arena come out in terms of leverage?
I think I kind of said a little bit, usually 50, 65%. Now, there are a few that will jump up to 70. We'll probably even do that even for our own balance sheet if we really like a deal. But, I can tell you, well, I think we're kind of hinting at, Steve is kind of hinting at, 10, 13 years ago, I guarantee you we would go up to 75%. I actually did a couple loans around Orlando on some apartment deals at 80%. But that's probably 2.0, 3.0 back in the old days. So I don't see many of the life companies jumping up in proceeds all that much, and don't really expect it. So, if that's one of the levers that gets pushed, we'll have to try to adapt to it. But.
Okay, let's look in the crystal ball a little bit as we go out through the end of the year and beyond. Rick, when you're out there looking for permanent financing, agency financing, Fannie Mae financing, it's anybody's guess where the interest rates are going. Just when we thought they were going up, everything started dropping again. Where do you see spreads on your cost of borrowing?
I would say today on a fixed rate, we would probably 240 to 250 over the 10-year or 7-year. So we're borrowing in the 4 to 4.25 range. I guess what's the 10-year today? 170, 180?
About 170.
Yeah, so about 4.25. We do a lot of float with a cap. So we like an embedded cap in our interest rate. So we'll do a floating rate that's got an embedded cap of probably 5.25 to 5.5. That's a great product for us because while we're in rehab, it's nice to have the floating rate, but the option, it's actually a 10-year piece of paper with Fannie Mae. It's a 10-year paper that has an embedded cap that we can roll into a fixed rate loan at any point in time. So if we do a Fannie Freddie as an acquisition, we have that option. Otherwise, we get a bank to do a floating rate with a cap.
Now, it's interesting. I've got some clients that are in the market right now for a Fannie Mae loan, and it seems like 4.25 has been the rate for a while. Is it just my imagination, or is the spread, flexing a little bit?
Yeah, you and I talked about this the other day. I think at the end of the day, 4.25 is the rate. I think they're going to either float it if interest rates go up a little bit or the 10-year goes up, they'll lower their spread. And as interest rates, the 10-year goes down, they've increased their spread. But I think that's what we sort of feel is it's always sort of 4.25 to 4.5.
And Pat, from your vantage point, how does Wells Fargo price loans? Are you pegging it on treasuries, swaps? How do you look at?
I do have one other thing.
Oh,
We
sure.
don't do it off treasuries. We do it off of LIBOR because we like that. That's been a little bit more stable for us than the treasury rate.
So Pat, how about from a pricing standpoint? If you look at the crystal ball, does your institution do some on-balance sheet fixed rate? Is all of that done through the CMBS channel, or do you do floating with swaps, or all of the above?
We actually do both. I mean, just given where we are in the market today, our CMBS group is still doing deals, and they'll put them on their balance sheets until the market sort of cleans up a little bit and where they can securitize them. I think we securitized a deal a couple weeks ago. For my group, we do primarily floating. Sort of on the construction, the mini perm, which is sort of our 3 to 5 year deals. If we go further than 7 years and try to go non-recourse, we'll do LIBOR based, but then ask for them to do some sort of derivative to fix the rate.
Okay. Dodd-Frank has been just very enjoyable for those of us in the banking industry. Increased regulation, proving that people can actually afford the loans that they're being granted. Some of it obviously is intended to really protect the consumer and protect the strength of the financial industry. There's about to be a change, and Steve, do you want to comment on some of the change that's about to hit the CMBS world?
Sure. I mean, Dodd-Frank, it's something we've all heard about now for a couple of years, but it's a law that was passed in 2010, but had many different facets to it. Some of which affected the banking industry for the on-balance sheet lenders. I think that was really the first area of focus for implementation. The securitized world and the portion of the law that was written as it relates to the securitized world is about to get implemented this year, and it's been rolled out depending on the different parts of the securitized world, whether it was credit card receivables or car loan receivables, et cetera. Well, for us real estate folks, particularly in CMBS, we're about to get our taste of it gets implemented, the laws get implemented for any securitization that is sold after midnight of Christmas Eve of this year. So who says the government doesn't have a sense of humor? They decided to pick that as their implementation date. So if you work backwards from that and you say, okay, well, every loan that gets closed, let's say after October 1st, has a high likelihood of being a loan that's going to be subject to the new risk retention rules. That, as you get towards, I'm kind of pegging it as end of the third quarter, beginning of the fourth quarter is when we'll see the issues from Dodd-Frank matriculate into the borrower world and into loans that are being done. So what does that all mean for everybody? Well, what's happening is under Dodd-Frank, they're pretty much turning the CMBS industry up on its head in terms of the requirements for how B pieces are held in those deals. And the B pieces, just like the name implies, you've got the ratings of each in securitizations of the safest bonds being the AAAs, there are mezzanine bonds, and then there's what's known as the B piece, which is the below investment grade piece. And up to this point in history, for the last 20-something years that CMBS has been in existence, the B piece has been bought by a community of buyers that are buying typically, in today's world, it's the bottom 7% of the deal. But in order to get to their yield requirements, they're buying it at a deep discount. So they're buying those bonds at typically 50 cents on the dollar. And they have the ability to trade out of some of the more senior bonds that they own. So it's kind of like if you were a developer and you bought a shopping center and you had a Chick-fil-A on an out parcel and you carved out that out parcel after you acquired it and sold it off to reduce your basis in the deal. That's the equivalent of what the BP buyer community has done up to this point. They've reduced their exposure and juiced their yield requirements by selling off some of the more senior tradable bonds. And the government, through Dodd-Frank, is changing all that. You have to buy the entire B piece at par, meaning you have to pay 100 cents on the dollar for it at issuance, and you have to retain all 7% of that B piece for a minimum of 5 years. So what does that translate then into for borrowers? If your B piece buyer, which is the crux of how deals get comprised, suddenly has to raise double the amount of equity that they previously had to do, and they have to hold it for at least 5 years and can't sell off any portion, so their yield requirements have now changed. Basically, the industry hasn't solved for how that is going to work. And there are different ways in which you could skin the cat and come up with different structures to try and satisfy the regulator requirements. There was a hearing in DC this week to try and get more, to one, debate some of the terms that are being implemented, and two, get more clarity on what the government wants out of, or wants the CMBS industry to come up with. And so, if you're a borrower, it's going to mean, depending on which smart person in the room you ask that has come up with the varying structures, it's anywhere from, you've heard 25 to 50 basis points more in loan spread related to just loans becoming part of the Dodd, what will get securitized after Dodd-Frank.
So let me jump in, because I'm not an expert in Dodd-Frank. What I think I heard you say is that the buyers of the riskiest part of these securitizations now have to put up more capital. They have to hold on to it for 5 years?
A minimum, yeah.
At a minimum of 5 years. So it really changes the dynamic of who would even want to do that.
Can I ask what, I'm listening to you. Does it have to also be Starwood in that situation?
The question was, does it have to be Starwood?
If you're securitizing it, does it have to be you?
Does it have to be a traditional B piece buyer, you mean?
I mean, you're
Or-
saying that, I thought when you said you securitized.
The loan originator, you
Yeah.
mean. So, and that's one of the points of that the industry is trying to get clarified around is how is it, who is it that's selling the loans? Typically the model up to this point has been banks have been some of the large lending operations of CMBS loans, and they're not in the business of retaining those loans. So they sell 100% of their exposure and they wipe their hands clean of it. And they, if something happens to that loan in year 1, 2, or 5, or 10, that's that loan has been sold off and securitized into the marketplace. The regulators want the origination shop to have skin in the game, and they have deemed that having a B-piece buyer involved will meet that requirement. But then there is ambiguity in the way that the bill has been written as to what you have to do to satisfy those requirements.
Okay.
So for example, one of the things that's being tossed around out there is to basically reverse roles in CMBS, where the B-piece buyer basically is the shop that takes the loans from the loan originators and buys them into a securitization, and then is the shelf that issues bonds. Whereas up to this point, it's been the other way around. It's been the big banks and their securities desk, their broker-dealer licenses that they've been using to securitize and sell bonds.
I don't know about you guys, but heads are spinning. Heads are spinning. Given that CMBS, and based on what I'd said in the beginning, the capital flows are so critical to our business. CMBS accounts for, I don't know, 25% or so. Is that about right?
About
debt
a quarter.
capital?
About a quarter of the commercial real estate debt is provided by CMBS.
Okay, so how does that impact the commercial banking business, Pat? If CMBS all of a sudden has some disruption, what has Wells Fargo done maybe in the past, as a big lender with a shop that does CMBS? What are some of the strategies, what are some of the opportunities created for the commercial banks?
I think the strategy, the opportunities created are just an opportunity for us to do more standing loans, right? So typically, what we found in this past cycle is that we'll do the construction loan, and once it's up and not even stabilized, it's gone. So this may give us an opportunity to hold the asset on our books a little bit longer and possibly earn a little more money on it. But that's how I see the opportunities. But I guess on the flip side, to the extent the market does dry out on the CMBS side, I think that our underwriting is going to probably be a touch more stringent as we look at the takeout for that too.
So let's maybe as one of my final questions to the panel, let's talk about opportunities that you see for the balance of the year, and maybe starting with Rick. Where do you see some of your best opportunities, whether it's in the Florida market or you're based up in Nashville? Where do you see great multifamily opportunities?
Well, we were just talking about it. I'm waiting for the crisis to hit him. We've said with this fund that our biggest opportunity are the CMBS world, the conduits that were done from 2005 through 2008 that are about to hit the fan. And there's a lot of it out there, not just with you, but what's going to happen with all that? And we're a buyer of older product, and so we like that. So we see that as one of our biggest opportunities. And the other thing is, Jim was talking a little while ago, we're also following the millennials. And I was in a conference about 2 weeks ago in Orlando, and the variance of in-town real estate from older to newer is dramatic in rents today. So where a new product is $2 to $3 a foot, the old product is $1 to $1.20 a foot. So we've sort of shifted our focus to more in-town, mid-town product throughout the Southeast. It's in most cities, it's the same case.
Steve, how about you going through the balance of the year? Where do you see opportunities for your business?
Well, and I think everybody's gotten the flavor from particularly the lenders that are up here on this panel. We each play in different parts of the pond. In CMBS, it's the higher leverage side of the pond that is where most of our borrowers come from. They're people that are borrowing between 70 and 75%. And up to this point, it's been a very competitive CMBS environment, particularly the last 18 to 24 months. There's some 43 odd CMBS shops that have hung a shingle out, some more active than others, and the volatility in the market and the I think some of the question marks that surround what will happen with the regulatory changes later this year position us well for conduit loans, a smaller universe of conduit players that are more sophisticated and have been around for a while and have done it. So there have been some shops that have been 2-3 guys in a Bloomberg trying to make loans and securitize them, I think a number of those folks will get weeded out of the marketplace.
Okay, Chuck, how about your business? Where do you see the opportunities? Specific to Florida, but also broader as you've got a broader reach.
Well, actually, the Southeast, including Florida, has been a bit of a laggard in the economy coming back. So, everybody can read any of these economic reports. Jobs are being created. Economic activity is very good. One of the things you always worry about is too much supply, particularly in the apartment side of things. We think that'll probably truncate. Everybody knows rents are going flat right now on new apartment product that's coming to the market. They're not really kind of hitting. If you started 2-3 years ago, you're probably blowing through pro forma. Right now, you're probably, in many markets, kind of leveling off. Maybe that's good. Maybe it's just 2-3% rent growth instead of super spikes. So, but for our lending side, we go head to toe with the GSEs. So we go head to toe with Fannie and Freddie. They get to borrow for free, so they have no real borrowing cost. But we try to compete with them. Competing with your federal government is kind of an interesting thing. But they provide a lot of capital, and sometimes they provide just kind of a editorial comment. When they can provide so much cheap debt on the takeout, it can overinflate and cause an asset bubble. And so of all the commercial product types, the one you worry the most about right now is multifamily. But we keep doing debt on every other product type. Apartments are just one I kind of watch a little bit. And since we acquire apartments quite a bit, we're kind of waiting a little bit to see this product get delivered, and then we'll underwrite when we see where the rents actually go. So our idea is to start buying in about 18-24 months.
Okay, great. And I hear the crowd outside starting. Pat, I'll let you wrap it up for this session. Any 30-second comments as to where you see opportunity for your shop?
We're actually starting to see some of our competitors pull back a little bit on the construction side. So I think if I had to say where our opportunities are going to be over the next 12 to 18 months, I think it's still going to be in the construction loans. And then depending upon how things fall out in the CMBS market, maybe some standing loan opportunities as well.
Great. Unfortunately, we don't have time for questions. If you do have questions, please come up afterwards. We're going to repeat this session, or you can obviously go check out another session. Thanks for stopping by.